Welcome back to Business with Joe. Starting a business is exciting, but one of the biggest challenges many entrepreneurs face is finding the right funding. In today's video, we will explore different funding options for startups, including bootstrapping, loans, investors, and crowdfunding. Whether you're just starting out or looking to scale, we've got you covered. There are several ways to fund your startup, each with its own pros and cons. Let's dive into the details of each option. Bootstrapping means funding your business using your own savings and revenue. Here are some advantages and disadvantages. Advantages: control. You maintain full control of your business without external influence. Equity retention. You keep all the equity in your company. Disciplined spending. It encourages disciplined spending and resourcefulness. Disadvantages: limited funds. Your funding is limited to your personal savings and early revenue. Risk: you bear all the financial risk personally. Bootstrapping is a great way to start small and grow organically. It works well for businesses with low initial costs or those that can quickly generate revenue. For instance, if you're starting an online business or a service-based business, bootstrapping can be a feasible option. When bootstrapping, it's crucial to manage your finances carefully. Create a detailed budget plan that outlines your expected income and expenses. Track your spending meticulously to avoid unnecessary costs. Use free or low-cost tools and resources to keep your expenses low. For example, you can use open-source software, co-working spaces, and digital marketing strategies that don't require a large upfront investment. Loans are a common way to finance a startup. You can get loans from banks, credit unions, or online lenders. Here are the pros and cons. Advantages: access to capital. You can access a significant amount of capital upfront. Fixed repayment schedule. You know your repayment schedule and can plan accordingly. No equity loss. You don't have to give up equity in your company. Disadvantages: debt. You'll have debt to repay regardless of your business's success. Collateral. Many loans require collateral, which can be a personal asset. Interest rates. Loans come with interest rates, which can add up over time. To secure a loan, you'll need a solid business plan, good credit, and sometimes collateral. Make sure to compare different loan options and understand the terms before committing. There are various types of loans available for startups, including term loans. These are traditional loans where you borrow a lump sum and repay it over a fixed period with interest. They're suitable for businesses with significant upfront costs, like manufacturing or retail. Lines of credit. This is a flexible option where you can borrow up to a certain limit and only pay interest on the amount you use. It's ideal for managing cash flow and covering short-term expenses. SBA loans. The U.S. Small Business Administration offers loans with favorable terms and lower interest rates. They're partially guaranteed by the government, making them less risky for lenders. However, the application process can be lengthy and requires thorough documentation. Now let's discuss investors. There are different types of investors, including angel investors and venture capitalists. Here's what you need to know. Advantages: large capital. Investors can provide substantial funding, which is great for scaling quickly. Expertise and mentorship. Many investors offer valuable advice, industry connections, and mentorship. No repayment. You don't have to repay the money. Instead, investors get equity in your company. Disadvantages: equity loss. You'll give up a portion of your business, which means sharing profits and decision-making. Pressure to perform. Investors expect high returns, which can create pressure to perform. Loss of control. Depending on the investment terms, you might lose some control over your business decisions. Presenter. To attract investors, you'll need a compelling business plan, a clear growth strategy, and a strong pitch. Networking and building relationships are key to finding the right investors for your startup. Let's look at the two main types of investors. Angel investors. These are affluent individuals who provide capital for startups in exchange for ownership equity or convertible debt. They often invest smaller amounts compared to venture capitalists, but can be more flexible and involved in the business. Venture capitalists, VCs. These are professional groups or firms that manage pooled funds from many investors to invest in startups. VCs usually look for businesses with high growth potential and may invest large sums of money. They typically seek significant equity and a strong return on investment. To prepare for pitching to investors, follow these steps. Develop a solid business plan. Clearly outline your business model, market analysis, revenue projections, and growth strategy. Create a pitch deck, a concise and visually appealing presentation that highlights your business idea, market opportunity, product or service, business model, financials, and team. Practice your pitch. Practice presenting your pitch deck to friends, mentors, or other entrepreneurs. Be prepared to answer tough questions and address potential concerns. Network. Attend industry events, join startup incubators, and leverage online platforms like LinkedIn to connect with potential investors. Lastly, let's explore crowdfunding. Crowdfunding involves raising small amounts of money from a large number of people, usually via online platforms like Kickstarter, Indiegogo, or GoFundMe. Here are the pros and cons. Advantages: access to capital. You can raise significant funds without traditional financing. Market validation. It's a great way to validate your idea and build an early customer base. Marketing exposure. Successful campaigns can generate buzz and increase visibility for your brand. Disadvantages. Time-consuming. Running a successful crowdfunding campaign requires a lot of effort in marketing and outreach. Uncertain outcome. There's no guarantee that you'll reach your funding goal. Fees. Crowdfunding platforms take a percentage of the funds raised, and you may incur additional costs for rewards and shipping. To succeed in crowdfunding, you'll need a compelling story, a clear value proposition, and a well-thought-out marketing plan. Offering attractive rewards and engaging with your backers can significantly increase your chances of success. There are several types of crowdfunding to consider. Reward-based crowdfunding. Backers receive a reward, such as a product or service, in return for their contribution. This is common on platforms like Kickstarter and Indiegogo. Equity crowdfunding. Backers receive equity or shares in your company. This is suitable for businesses looking for larger investments and willing to give up equity. Platforms like Seed Invest and Crowdcube offer this model. Donation-based crowdfunding. Contributors donate money without expecting any return. This model is often used for charitable causes or community projects on platforms like GoFundMe. Debt crowdfunding, also known as peer-to-peer lending, where backers lend money with the expectation of being repaid with interest. Platforms like Lending Club and Funding Circle facilitate this model. To create a successful crowdfunding campaign, follow these steps. Tell a compelling story. Clearly explain your business idea, the problem it solves, and why it matters. Use high-quality visuals such as videos and images to enhance your narrative. Set realistic goals. Determine how much money you need to raise and set a realistic funding goal. Explain how the funds will be used. Offer attractive rewards. For reward-based crowdfunding, offer enticing rewards that appeal to your backers. Ensure they are achievable and deliverable within a reasonable time frame. Promote your campaign. Use social media, email marketing, and press releases to spread the word about your campaign. Engage with your audience and keep them updated on your progress. Prepare for fulfillment. Plan how you will fulfill rewards and manage logistics after the campaign ends. Communicate transparently with your backers to maintain trust. In summary, there are several ways to fund your startup: bootstrapping, loans, investors, and crowdfunding. Each option has its own set of advantages and disadvantages. The best choice depends on your business model, financial situation, and long-term goals. Thanks for watching. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more tips on starting and growing your business. Leave any questions or comments below. We'd love to hear from you. Good luck with funding your startup.